if the return of the market was 0, you'd expect Cook and Bieler to return about 8.47%. That's in a quick and dirty nutshell there. Back to the screening, we had 30 to 60 names that we looked at initially. In our offices then we sat down, looked at the managers, and for whatever reason eliminated 20 to 50 managers to get that down to a list of 10. Managers from that list were taken off due to the fact that perhaps we knew that a portfolio manager had just recently left. We're not sure who's managing the money there. They may have been a very concentrated portfolio, holding 10 names. We don't want that type of portfolio running the county's money. We're looking for a more diversified portfolio. On the fixed income side, they may have been holding half the portfolio in emerging market debt. We don't want that type of manager running the county portfolio. So from there, we narrowed that list down to 10. From there, we called each of those 10 managers, confirmed that they were open, got some additional information, cut that list down to 5, which we presented in a report. From there, we picked 2 of those managers to actually come and present. So that's how we whittled the big universe down to the actual presenters. To start off with the large cap value manager, of course we immediately deviate from that. You'll see that there's 3 listed here: Cook and Bieler, C.S. McKee, and Lord Abbott. The reason we had picked 3 is C.S. McKee was one of the recommended names to come in, considering that they had recently managed money for the county and were fired, and additionally that they currently manage the international portfolio. Hiring them on the large cap value side could cause some problems. By having them manage large cap value and international, you're taking what's called manager risk, meaning if something were to blow up at C.S. McKee, all of a sudden you have 2 asset classes that are going to be detrimentally affected. Because of that, and if we figured if C.S. McKee gets thrown out immediately for one of those reasons, we don't want to have the other manager win by default. We may not like the other manager, but they were automatically going to get the mandate. We decided to bring 3 in for this particular asset class. Page 1, we look at all of the statistical numbers for each manager. We start with the 5 and 3 year return. The highlighted box represents the best performing manager for each category. You can see Cook and Bieler with a net of fee returns of 10% for 5 years, 6.7% for 3 years. We also look at the alpha, as I described. You can see 8.47, Cook and Bieler was the top performer there. We also look at up markets and down markets. What we do there is for the previous 5 years, we take all quarters that the Russell 1000 value was positive, above 0, and link all of those together. We do the same for the down market, so we can see how each manager did when their appropriate index was up or down. You can see Lord Abbott on the up markets had the most positive return, up 41.5%. C.S. McKee and basically Cook and Bieler, slightly behind, had the best down market. That tells us when the markets are going down, they'll be able to cushion the fall a little bit more. We also have the fee listed there. Lord Abbott has the lowest fee. Page 2, basically what I just said, almost my script for each manager. Just going through and repeating where they rank in each universe. For example, for net of fee returns, all 3 managers over the 5-year period were in the top 5% of all large cap value managers. Over the 3-year period, McKee and Cook and Bieler were in the top 5%. Abbott ranked in the top 25%. So that's just some commentary on the previous page. Looking at numbers is one thing, but looking at the actual dollar values, I think really brings the point home a little more. What we did here is we took a look at each manager over the trailing 5 years at their growth of $10 million. Now the actual mandate for large cap value will be about 15. The 10 million is a little easier to comprehend, I think, when you look at the numbers. Looking at Cook and Bieler at 10% versus C.S. McKee at 9.4, to see what dollar value that translates to, you can look at the far right-hand side. You can see over a 5-year period, Cook and Bieler would have gone to $16,610,000, C.S. McKee to $16,200,000, Lord Abbott $15,620,000. So you can see that's the effect of compounding over that 5-year period. Looking at this, you can see Cook and Bieler had the stronger dollar value return in addition to the strongest percentage return as well.
Do you know what changed in September of 2001 where they were down below everyone else but suddenly are higher?
For
Cook and Bieler. In the trailing 5 years, they suddenly...
Oh, they had trailed for a long time?
Yes.
Cook and Bieler had trailed due to the down market performance. They made that up really starting in about March of 2001. You can see they started to pop up ahead there. And then once the markets really started to take off, they were able to have a lot of really strong upmarket performance. In addition to 2001, when the markets were down pretty negative, they were able to have actually positive return. One of the attributes about Cook and Bieler over the past 27 years, they actually had 26 positive years, and that includes a couple bear markets. 2002, when the markets were down 22, was their only negative year. So they're just coming off their only negative year as well. In addition, back if you look at 98, 99, when they're down below, the markets were really booming then. Cook and Bieler tend to not do as well as some other managers when the markets are really roaring. They're a little more conservative, but in the down markets, they can really pick up a lot of that they've lost. Page 4, observations from the presentations, and Jack and Diane, feel free to jump in as they sat in on the 2 almost solid days of sitting through manager presentations, which was quite a treat. CS McKee, the way they run their money, they really run about 3 quantitative models, meaning they have almost a black box that they run. They punch in a bunch of numbers, the computer spits out some stocks, they took a look at those stocks and picked their portfolio from there. There are pluses and minuses to having a purely quantitative process like that. The positive is when it's working, it's really working. But when it misses, when there's an anomaly in the market that the model isn't picking up, it could take them a few quarters to pick up there. Lord Abbott and Company, they were the only large cap value manager who were recommending a mutual fund, institutional class mutual fund. They use both quantitative and fundamental, meaning they will use some computer screens to get their initial universe of stocks, and then they do a lot of in-depth research, looking through the balance sheets, interviewing companies to select their managers. And finally, Cook and Bieler, very research intense. They are all what we call a bottom-up manager, meaning they pick all of their stocks from the bottom up, basically. They build the portfolio stock by stock. They don't look at the entire economy and say, okay, I think financials is going to be a good place to be. Let's load up in financial stocks. Whatever stocks they feel are going to do well, regardless of what sector they're in, they're going to jump into. From the interviews themselves, I think, at least with myself and my colleagues from Yanni who were here, we were most impressed with Cook and Bieler. They had a very logical approach to investing. Their analysts who pick the stocks are compensated by how well those stocks do and by what stocks they didn't put in the portfolio. So they have a lot tied into how well the portfolio does as well. They have a small number of holdings, 30 to 50. You can get proper diversification from about 15 to 20 stocks. So it is a diversified portfolio, but it is the most concentrated. They have a very low turnover. Only about 20% of the portfolio is turned over on a yearly basis. That's something to consider when we're looking at fees. Commissions can be a large part of fees in a portfolio. So our final recommendation on the large cap value side would be to hire Cook and Bieler for the mandate. I don't know if we need to do manager by manager or just go through all at the end as far as go through them all. Okay, the large cap growth side, we brought in 2 managers, Gardner Lewis Asset Management out of Chadds Ford, Pennsylvania, Waddell & Reed out of Kansas. You can see from the performance numbers, right off the bat, Gardner Lewis has a pretty immediate advantage. They have the top number in all categories with the exception of down market where they're actually tied with Waddell & Reed. Both managers were in the top 5% as far as returns go for 5 and 3 years, both in the top 10% for alpha. Up markets both were in the top quartile, down markets both were in the top quartile. Waddell & Reed's only advantage is in the fee, 60 basis points versus 85. However, the 5 and 3 year returns are adjusted for that fee. So despite having a little bit of a higher fee for Gardner Lewis, they still have much stronger returns over the long and short term. Page 6 again, just some commentary on that. Page 7, the growth of $10 million chart again. The mandate here again will be about $12 million when it's all said and done. You can see pretty much for the most part, with the exception of a couple quarters, Gardner Lewis has been up and above Waddell & Reed for the most part, ending up with a final market value, if we were to invest $10 million 5 years ago, of $17,720,000 versus Waddell & Reed at just over $15 million. So a pretty big difference there of about $2.7 million. Looking at the presentations, Waddell & Reed really focuses on high-quality stocks, and that's really hurt them over the past year. If you remember, high-quality stocks have really lagged the market. The lower-quality stocks have really pushed the market forward. They've been hurt by that recently. Gardner & Lewis, while they do invest in high-quality stocks somewhat, they're not limited to that. We felt that was a good mix with Cook and Bieler when it was all said and done. Because at this point in the portfolio, when we had the one piece in place, Cook and Bieler, we need to start building together. We don't look at each manager in a vacuum and say, okay, they're the best here, they're the best here. We want to see how they work together. Cook and Bieler, as I said, in the up markets, they're really not going to roar as much as the market. Gardner and Lewis in the up markets are really going to pick up a lot of that alpha. They're really going to get some of the stocks that Cook and Beeler may not, so we feel they're really going to mesh well together.